Good day, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Monday. It's February 7th. It is the first day of the second week of February 2022. Don't ask me where the year has gone. I have no recollection. As you can see here, the NASDAQ is up 20 pre-open. The S&P is up 3. The Dow's up 6. This is randomness. This means absolutely nothing. For all we know, the market can open down 100 points or up 100 points. Not saying that it will, but I wouldn't make too much out of this. Anything on the Dow that's below 85 positive or 75 positive or negative is random. So this is just randomness. And that's okay because the markets have been anything but random the last couple of weeks, if you know what I mean. Looking at the weekly docket, the big report this week is going to be the Consumer Price Index. That's going to be very, very huge, followed by consumer sentiment. Consumers make up 2/3 of the economy. Retail sales makes up 2/3 of the economy. GDP makes up 2/3 of the economy. So consumer sentiment is going to be a very important report. Also want to see how the Red Book, which is a private retail sales number, does as well. Let me just look at the expectations for that number. But those are going to be the big reports. Yes, store sales year over year. Can't wait to see what this report is. Now, I want to tell you guys something really, really important. And again, consumer sentiment, CPI. International trades in goods and services is not going to be as important, but it is relevant. It's not going to be a big week for Fed data, but it is going to be a big, big, big week for earnings. And when I get into my sector analysis, which I will in a minute, where we go through all the sectors, I want to tell you what the dangers, the pitfalls, and the opportunities are with earnings. But I'm very nervous because I was hoping that the earnings would cause the consumer discretionary and tech stocks to start making higher highs, and it's not the case. We'll go through that in a minute. Now, in terms of global economy, and I'll give you all the levels and everything right now. Now, shares were higher Monday in Europe after mixed trading session in Asia, where Shanghai benchmark jumped after reopening from the Lunar New Year holidays. It's New Year's in China. Tensions over Ukraine persist with French President Emmanuel Macron set to hold talks in Moscow on Monday. Now, let me ask you guys something. Why is he going there? Why is he sticking his nose where it doesn't belong? Do you think the French president is going to have any influence on Biden? Let's be honest with each other. I mean, that's called being a fool, right? I mean, like, do you think Putin's going to listen to this guy? Do you think Putin's even going to tell him what we're doing? I mean, this is just a complete political, trying to make nice with France. Folks, this is not going to do anything for Ukraine. I don't think anyone can talk Putin into or out of anything. So he's set to hold talks in Moscow on Monday with President Putin before visiting Ukraine. Yeah, that's going to really help a lot. What a moron. Trying to de-escalate the situation. Yeah, he has a pattern of de-escalating the situation. Don't even get me started on this. That's called a buffoon move, okay? Macron spoke with President Joe Biden on Sunday. Yeah, I'm sure he helped out a whole lot. People just have a need to stick their nose where it doesn't belong, you know? This week brings earnings reports from some of the region's biggest companies, including Japanese automakers. They may provide update on the shortage of computer chips and other disruptions and pressures related to the pandemic. And by the way, General Motors in their earnings 2 weeks ago said that the shortage in the chips is not holding them that bad, and the shortage is not that bad right now. That's direct from General Motors less than 2 weeks ago. Surging COVID infections in the region because of the Omicron variant are also weighing on sentiment. Much of Japan is under government-backed requests for restaurants and bars to close early to slow the explosive growth in cases and hospitalizations. Although about 80% of Japan has the shots, only about 5% received the booster, and it seems like this Omicron is giving people bad side effects who have not received the booster. Going back to the U.S., the U.S. Labor Department said they added 467,000 jobs. That's 3 times as much as we anticipated, and that's putting the Fed in a corner to actually take action. Some economists had expected a loss of jobs amidst January surging COVID infections. Didn't happen. But what did happen is this report caused the bond market to sell off and break the support level. And we're seeing divergence now, so I think this is too much too fast, and I think we're going to go back to its base level. But let's get back on this. If the number was really, really low, it would bolster the case for not taking action by the Fed. But the fact that employment levels are so high, the Fed's going to say, hey, we told you so, the economy's heating up faster than we expected. Treasury yields leaped following the job report's release, tracking forecasts that the Fed will hike short-term interest rates more aggressively than expected. And remember, when bonds go down, interest rates go up. There's an inverse relationship. Now, the trend is down, which is why we're not picking this low, because I would love to buy this right here. And we're seeing divergence. Look at this. The lows, lower lows, higher lows on the momentum levels. That's a sign that this is overdone. And we're going to go back, but we don't want to trade against the trend. I'd like to see it go higher, break a little bit above, maybe go to the 150 level, and then I will sell the heck out of this thing. Volatility is holding off. It's not peaking anymore at 30. This looks like the panic selling or panic is over. It looks like we reach these peaks and then we cool off. I think we're going to head a little higher and then cool off. Here is where I'm seeing the big problems. Let me show you where I'm seeing the big problems. These are the 11 major sectors. And let's focus for a second on consumer discretionary. Now, I see here it's basing out and it's looking higher. But the problem here is if this sucker doesn't rally, like in the next week, we're going to have a big problem, because my hope is that the earnings on consumer discretionary stocks are going to be able to put some upside and cause the consumer discretionary and the technology sector to break out higher. I don't know if that's going to be the case, but this is going to be a crucial week for earnings. So if it is going to happen, this would be a really good time to see a breakout to the upside on consumer discretionary and technology. If you look at financials, notice they're much higher. They look like they want to go up again and take out the high. Energy is in a beautiful, strong uptrend. Utilities looks like if they can break 70, they can go higher. Consumer staples is almost at new highs, and I like consumer staples here. Basic materials looks like it's coming down. Healthcare looks choppy. Technology, these are the ones we got to pay attention to. I want to see technology, the XLK. I need to see it break above the 164.60 level, and we need to see the consumer discretionary break above the 188.30, the 190 level. I'd love to see it at 190, XLY at 190, and tech at 165. I'd really like to see that. If not, we're going to have some problems. If not, we may end up seeing this. See the communication sector huffed and puffed and then went back down? We may end up seeing that come down instead of up. And if that's the case, the NASDAQ is toast. So very, very, very important. We got to keep an eye, especially on earnings, because this is going to be a big, broad week. So I want to see the earnings pull these sectors above. Let's look at individual or broad market sectors. S&P's trailing between the 50 and the 200-day line, which is okay. It's not below the 200-day line, but I'd like to see it above the 50-day line, which will happen if consumer discretionary and technology can rally. So the number here is 460, 62, 461-ish. We need to see it break above that. The Dow, on the other hand, let's see here. Dow Jones, all we need to do is we need to see it break the 355, 366 level. If we could see it do that, I would be very, very happy right now, because then it would mean we have a chance of making all-time highs again. And then we've got the QQQ, and for the Qs, which are really sucking it right now, I need to see it break above the 200-day. This sector needs to break above the 200-day. This is the sector. If anything's going to get us out of trouble, it's going to be the QQQs, and the only way the QQQs will rally, and we need to see it break the 367 level, is if XLK, and I'm telling you folks, this is important here. We need to see the XLK break above this level right here, the 164, 165 level, and we need the XLY. This is important levels you got to pay attention to. We need to see this break above the 200-day moving average and not any part of it touch the 200-day moving average. Like these two bars here. Notice the lows don't touch. Here the low touches it. I want to see the low not touch these levels. Now, I like the congestion that we're breaking here, but I'd like to see upside. Now, if we can break up at least to the 50-day line, I'll feel a lot better. But I'm telling you right now, if consumer discretionary and if technology can't rally, if these two sectors can't rally, you're not going to see, or the odds are very highly that you are not going to see the QQQ break above the 50-day line, and we need to see it break above the 381.27 or the 381 level. Otherwise, we're not going to be in a good position in broad market, because the NASDAQ will just cause the overall market to slip again if this is bearish. Because keep in mind, it's got Microsoft, it's got Apple, it's got Amazon, it's got all those stocks that have a huge market cap, and all those stocks are in the S&P 500. So remember that. I'm giving you really, really wise advice. In terms of sectors to look at, let's look at individual sectors. Individual stocks. In terms of individual stocks, if you look at the S&P right now, Devon Energy, I want to show you how good my CSI scan works. February 4th, right? That's Friday, because this is backdated one day. Devon Energy, let me show you. A week ago. Devon Energy, January 28th. Look, let's go back another week. Devon Energy, January 21st. Let's go back another week. Devon Energy, second spot. January 13th already. Let's go back another week. Here we go. Devon Energy, 1, 2, 3, 4, 5, sixth spot. December 13th. Let's go back another week. Devon Energy, 1, 2, 3, 4. Do you see why I used the CSI scan? We're going back to December 6th, and Devon Energy is still one of my top 5 stocks. Let's go to today. Devon Energy. The point is, my CSI works really, really, really well. And sometimes when they get up here to the top 3 or 4, they end up staying here for a while. So Devon Energy, US Marathon, Apache, Halliburton, energy, and more energy. And a baby industrial in there. On the downside, PayPal, Moderna, Etsy, General Holdings, Twitter, Netflix, all the speculative stocks that were making all-time highs, Cuervo, Gap, all the stocks that were making all-time highs a year ago are all in the crapper right now. So speculative stocks doing terrible, energy and defensive stocks doing better. Keep your eye on those levels this week, folks. Now, before you go, I want to tell you something very, very important. The markets have been literally all over the place, yet we've still been able to hit an 85% win rate on closed trades over the past 4 months. People may wonder how we did this. Well, in short, I've been taking advantage of a mega pullback that just happened. Traders can see what I did differently to make sure the scales tipped in our favor. I'm going to show you everything. It's all laid out in my 2022 buyback plan, which we'll discuss at length with expert trader Tom Busby, T-Buzz, in a complimentary trading course that I created for you. Now, T-Buzz and I did this on Saturday, and T-Buzz called me afterwards. I swear on my mother's life. He said, Roger, this is the best class you've ever had. I'm not kidding. He said it's the best class that I've ever had. And he was part of it, so he was in too. Check it out. There's no cost. There's no obligations. You're going to love it. It's all laid out in my 2022 buyback plan. We'll discuss at length with expert trader Tom Busby. It's complimentary. It doesn't cost you anything. Click the link below to access. Do it now. Follow the link below this video. Do it now. Tomorrow, strongest sector, strongest stock. Weakest sector, weakest stock. Now follow the link below. Check out my 2022 buyback plan. It's very, very good, solid information. It lays out all my logic and all my reasons for why the market's going to go up and all the reasons why the market is stuck. Check it out now. No obligations, no cost. Pure meat and potatoes value. Follow the link below this video. Get in on it now. And send me feedback. Support at marketgeeks.com. I want to hear from you guys. Bye. Have a great week and stay out of trouble. Bye.